Right. So, as you point out, the Fed could cap long-term rates, yield curve control. That's something that isn't an issue now, but it will be as the economy begins to pick up steam if it is. The Treasury has not used all the money that the Congress gave it to give to the Fed to make more loans. So the Fed could make its loan programs more generous. It said the other day, as it widened the eligibility for the Main Street lending facility, that it's working on a program to lend money to nonprofits as well. So one thing the Fed could do is basically lend more money on more generous terms to more people, if the Treasury is willing to stand behind it.
Sure, absolutely. Bill, how does that sit with you?
I think that sounds great. In fact, the key thing about Fed monetary policy this cycle is that it's liquidity assurance and market functioning assurance. And it's not so much a matter of rates. Of the rate capping and negative interest rate story, in some sense, is a misnomer. We have to make sure that businesses survive the recession, and that means giving them liquidity. And David's right about the lending facility. But I think we could do more, because the lending so far biases the capital structure and incentivizes the managers to do the same old things. And what we're missing would be innovative changes, which we need now when we restructure the economy. And that's something that equity financing gets you.
Well, so, Bill, let's stay on that point for a moment. Your concern here is that the Fed is going to undermine productivity in the long run. What do you mean by that? Because
one of the things about incentives for managers is that if the last thing that the lender wants to hear is, I'm going to be doing something new with your money and be innovative and try something new. Right. They want their money back. Whereas an equity investor, all he wants to do is make a lot of money. So he's going to say, train better people, get whatever innovations you need in place, and let's make a lot of money and come back strong. And that's the kind of incentives we need right now, because the economy itself has to be restructured with all the stay-at-home, and we see the inefficiencies that the old technologies are giving us. Well, we need our new technologies, and that's what you get with equity investment.
One more on this point to make sure I understand it. What would that look like, Bill, coming from the Fed?
Yeah, the key is the Fed has focused on credit markets, and we talk about buying loans and giving more easy loans. What the Fed should start to do would be buy equities the way the Hong Kong Monetary Authority did during the crisis, buy a big ETF and support the equity market. Incentive and in the micro sphere, allow more IPOs to come on the market and perhaps buy packages of IPOs in different sectors to encourage a newer, innovative investment.